increasing geopolitical contact after a period of relative harmony, and you have a highly leveraged system. So in many ways, it just continues to resemble the 40s, closer than I could have imagined. In the developed world, we've been in a 40-year period of disinflation, which doesn't mean deflation, but it means lower inflation compared to the end of the 70s, and consequently lower and lower bond yields and rising debt to GDP. And that goes back to the long-term debt cycle I talked about. And so a lot of back tests, a lot of assumptions about equity performance and real estate performance, all these different asset classes, they've had this 40-year tailwind of lower and lower interest rates, which when you use interest rates as a discount rate, as they go down, it lets you value other assets more highly, and it makes financing costs cheaper. So you can have a higher house to income ratio. You can have a higher stock market to income ratio. You can as yields go down, things get more and more financialized, and it's a structural tailwind for assets. And if as we hit roughly zero, some countries you hit negative, and if you start going sideways on yields, let alone if you start going up in yields because of inflationary pressures and things like that, that can be a headwind for a lot of assets. And so kind of the chart of truth is looking at the long-term US Treasury rate and see that it's been in this very tight, 30 to 40-year downtrend. You go through these periods of long-term debt cycles. So you build up, you have the short-term credit cycle, you build up debt in the system, then you get some sort of event or some sort of, say, monetary tightening cycle that kind of washes it out. You get a period of partial deleveraging, but then you start building up debt again. And you never go back to your baseline. Instead of a sine wave of debt that goes sideways, it's like an upward trending sine wave. And so you get higher and higher debt as a percentage of GDP and lower interest rates until you hit zero interest rates or even slightly negative, and you get extraordinarily high debt levels. And historically in history, when you hit that sort of period, you get basically currency devaluation, debt monetization, and financial oppression, which is basically that you start to get large fiscal expenditures and they hold interest rates low. And so you get pretty high inflation, pretty high nominal GDP growth because the large inflation component, while they're holding debt well below the inflation rate. And so because basically if you have 100% or 150% debt to GDP, if you do the math on interest rates, you can't really have structurally positive real interest rates. And so you get that period of financial oppression. So there's that old quote that history doesn't repeat, but it rhymes, right? So my point with the 1940s is not that we're going through an identical period, but that it's the closest period that we should be familiar with. If we're basically things that seem shocking are less shocking in financial markets to you if you are familiar with the 1940s. You're like, oh, it's kind of like what happened there. And so it's basically the closest template we have. And then the question becomes, how do we differ from that template? What are the differences? Because it's not identical. And one example is that back then the United States was running structural trade surpluses. And the UK, the existing power at the time, was the one running structural trade deficits. And so now in many ways, the United States more resembles the UK from the 1940s, where they're the leading power, and they have the structural trade deficit against a rising power, which back then was the United States, and now is China. And that doesn't mean that it's going to follow the same exact pattern. There's obviously different geographic differences. There's all sorts of differences there, but there is kind of a semblance there. And humanity's had pandemics in the past, and if you don't have a lot of leverage, it's not that it's obviously still bad from a humanitarian standpoint, but from a financial standpoint, it's not the end of the world. But if the whole system's so tightly geared and there's so much operational leverage and financial leverage that it can't absorb shocks, right? It could be anything. It could be a natural disaster. It could be a virus. Could be a war. If something hits a system that levered, you get these. Basically the system cannot let itself collapse. Credit markets are based on always expanding. And that's why these kind of recessions have gotten kind of shorter and crazier with bigger and bigger government responses. And so when you're kind of at the long-term debt cycle, you're already at the zero bound in terms of monetary policy, and you get a big shock to the system, you get a massive fiscal response. And so it looked like wartime finance, even though we weren't in a kinetic war with another country. We were at war with biology, essentially. We're at war with just saving our levered system, increasing geopolitical contact after a period of relative harmony. And you have a highly levered system. So in many ways, it just continues to resemble the 40s, closer than I could have imagined. Basically, in all those long-term debt cycles where you get kind of a big shift in monetary policy, you also have rising populism and things like that. And so it's not surprising that you get wars in those periods. And basically, those wars are kind of the catalyst. And I was hoping that this period would be one without a kinetic war, and that it would be purely kind of humans versus nature, or humans versus their own leverage, essentially. But now, yeah, we're throwing kinetic war into the mix, and so it's unfortunately even closer to the 1940s. And now I would say hopefully the war doesn't get anywhere near the scale as it was in the 1940s. Gold is important now. I think part of it is having it in your own jurisdiction. So no stable coins, no paper claims, but just having it in your own country vaults is important. But for people and for other institutions, I do think that we do have a variety of gold-backed stable coins. I think you can have other commodity-backed stable coins. They're interesting. Obviously, you have fiat-backed stable coins, and then you have bare assets themselves, like Bitcoin. And I think that there's going to be kind of a transition over time. And my general approach is to focus on scarce assets. So I like gold, I like Bitcoin, I like appropriately priced real estate, I like appropriately priced equities, commodities, things like that. And I do think that we're going into a world where reserve practices are more diversified and perhaps more focused on scarce assets, and even things like just higher commodity inventory, strategic commodity reserves, things like that. Well, I would say we're in the process of testing Bitcoin's hardness. So if we go back to gold for a second, right? I mean, if there's 200 trillion in bonds and cash, there's something like 12 trillion in gold, right? So if you were to pour some of that big cup into that smaller cup, gold would have to be much bigger to absorb it. And in the 70s, you had crazy shocks. Like you had gold go from 35 an ounce pegged up to hundreds in a very short period of time. And then it, eventually reached a bubble, and then it stabilized. And then it kind of went this long period where the treasury was the reserve of the system. That started, like we said, that kind of peaked in 2000, which is also roughly when gold bottomed. That was like the UK sold part of their gold at the bottom of their official gold reserves. Then we just, we had this like decade of almost straight up in gold, right? So you can have things like where decades happen in a year, and then for decades nothing happens, right? So gold and these kind of monetary shifts happen like that, where these markets can get big enough if the much larger asset becomes far less desirable, and just money has to keep pouring into those new assets. And so bringing it back to Bitcoin, I think it's we're seeing it's monetizing over time. Right now, it's a 13-year-old asset, right? So we can't just put $1 trillion into it and say, okay, well, this is our hardest asset ever. It's our sovereign reserve. This is where we're putting decades of accumulated trade surpluses. Gold's historically been the safest asset you can imagine, but now there's questions like, could gold be demonetized by Bitcoin, right? So there's nothing that's risk-free.